This is one of those numbers that is so big, people stop feeling it. $2 trillion a year. Not once. Not in a recession emergency. Not during some one-off crisis. Every year, on average, through 2036. And the reason this matters is not just that the number is huge. It is that a number this large stops being a policy detail and starts becoming the background condition of the entire financial system. GAO just made that brutally clear. In its new Federal Debt Management Report, GAO says the Congressional Budget Office projects federal deficits will average over $2 trillion annually through 2036, which will keep adding to the national debt. GAO also notes that debt held by the public was already over $31 trillion in February 2026. That sentence should bother you, because most people still think about government debt the way they think about a messy garage. Too much stuff. Probably not ideal. Somebody should deal with it eventually. But life goes on. That is not what this is. This is not a messy garage. This is a machine that needs to refinance itself constantly, while also borrowing another roughly $2 trillion a year on top of what it already owes. And when the machine gets that large, every other market starts orbiting it. That is the real story, not debt is bad. That is too childish to be useful. The real story is that when deficits stay this large for this long, they begin to reshape interest rates, treasury issuance, inflation sensitivity, political incentives, and ultimately what kinds of promises the government can keep without distorting everything else around it. That is the level this has reached. And GAO is not saying this in the language of panic, it is saying it in the language of administration. Treasury is responsible for financing the borrowing. The borrowing is projected to remain enormous. The debt keeps rising. The fiscal path remains strained. That calm tone actually makes the message more serious, not less. Because if a government watchdog is calmly telling you that the system is on track to add more than $2 trillion a year to debt through 2036, the problem is no longer hidden. It is normalized, and normalization is what makes big fiscal problems dangerous. Let me make this concrete. Imagine a household with a huge mortgage, multiple credit cards, and an expensive lifestyle. Now imagine that household is not just rolling its old debt, but also adding a massive new balance every single year. If rates fall, the pressure eases. If rates stay high, the pressure compounds. If income grows fast enough, maybe the burden feels manageable for a while. But if borrowing keeps outrunning the household's underlying ability to stabilize its finances, eventually, the debt itself starts dictating the family's choices. That is where the United States is heading. Not toward immediate collapse. That is lazy thinking. Toward constraint. Toward a world where debt service, rollover risk, and financing needs become too large to ignore, and where fiscal policy becomes less about choice and more about managing the consequences of past promises. GAO's broader fiscal health work has been warning about exactly this. In its 2025 Fiscal Health Report, GAO said the federal government remains on an unsustainable fiscal path, and projected debt held by the public would reach its historical high of 106% of GDP by 2027, then keep rising faster than the economy over the long run. That phrase matters: unsustainable fiscal path. Not because the government runs out of money next week, but because unsustainable means the trend eventually breaks something. Maybe not all at once, maybe not in a cinematic way, but something gives. Usually, what gives first is flexibility. That is what most people miss. They hear big debt numbers and think the issue is some future national bankruptcy scene. That is not usually how advanced sovereign fiscal problems work. The issue is that debt absorbs room. It narrows options. It makes the government more dependent on favorable financing conditions. It makes rate shocks more painful. It turns normal downturns into more dangerous events because the starting position is already stretched. And once the debt stock is large enough, the government starts behaving differently because it has to. This is where the story gets more interesting. Because $2 trillion a year is not just a debt story. It is a rate story. Treasury has to finance that borrowing. GAO's recent report is specifically about federal debt management, and it says Treasury seeks to meet the government's borrowing needs at the lowest cost over time. That sounds dry, but it is actually the heart of the matter. When borrowing needs stay enormous year after year, Treasury's financing strategy stops being a background technical function and becomes one of the most important forces in the financial system. More issuance matters. More refinancing matters. The maturity structure matters. Who buys the debt matters. At what yield they buy it matters. And if the market starts demanding higher compensation to absorb all that supply, then interest expense rises, deficits get worse, and the machine starts feeding itself. That is the trap. Not a one-day debt crisis. A slow fiscal feedback loop. Borrow more, pay more interest, borrow more to cover the interest, then hope growth, inflation, or financial repression helps contain the damage. That is not a fringe theory. That is what large debt systems eventually wrestle with. And the United States has one enormous advantage here. It issues the world's reserve currency. That matters a lot. It buys time. It supports demand for treasuries. It gives the system more flexibility than almost any other country on Earth. But reserve currency status is not a magic wand. It does not make math disappear. It changes how long the market tolerates the math. That is different. A lot of investors still act like the US debt problem can never matter because America is special. In one sense, yes, it is. In another, that belief itself creates complacency. The more people assume the market will always absorb whatever Washington issues, the more shocking it becomes when absorption starts requiring meaningfully higher yields. And we have already seen glimpses of that broader pressure in recent years. Bigger deficits, higher rates, rising treasury supply, more attention on auctions, term premium, and debt service costs. This is no longer theoretical. Now let's ask the question that actually matters for investors. What does this do? First, it keeps pressure on the long end of the rate complex. Not every day. Not mechanically, but structurally. A government projected to add over $2 trillion a year to debt through 2036 is a government that will remain a constant borrower. Constant borrowers shape markets. Second, it increases the political temptation to solve debt indirectly. That can mean inflation tolerance. That can mean financial repression. That can mean leaning on growth assumptions. That can mean tax changes. That can mean entitlement fights. That can mean quietly hoping nominal GDP outruns the burden. But very rarely does it mean clean, early discipline. That is not how democracies usually behave when the bill is this large. Third, it matters for every asset that competes with paper promises. Gold cares. Silver cares. Hard assets care. Why? Because when the sovereign balance sheet gets pushed harder for longer, investors eventually start asking whether the real value of fixed claims will be protected the way they assume. Debt this large does not just raise default questions. In the United States, the more relevant question is often currency quality and purchasing power over time. That is why debt stories eventually bleed into inflation stories, real rate stories, and precious metals stories. Not instantly, but inevitably. Fourth, it changes the psychology of the market. A country adding more than $2 trillion a year to debt through 2036 is not in a temporary patch. It is in a regime. And once investors internalize that they are in a regime, they stop treating large borrowing as an exception and start pricing it as the new normal. That can affect everything from equities to bonds to the dollar. Now, I want to keep this disciplined. This does not mean hyperinflation is coming next month. It does not mean treasuries are suddenly uninvestable. It does not mean the government hits a hard wall in some neat calendar year. That kind of content gets clicks, but it destroys thinking. The real message is more serious than that. The fiscal path is large enough now that it deserves to be treated as a structural force, not a political talking point. That is the upgrade in thinking, not be scared. Be precise. GAO is effectively telling you that the United States is projected to keep borrowing at a massive scale for another decade, on top of a debt stock that is already above $31 trillion held by the public. That means the debt itself is no longer just a result of policy. It is becoming one of the conditions under which all future policy must operate. And once debt becomes a governing condition, markets stop being able to ignore it forever. That is the real thesis here. The government is projected to add about $2 trillion to the debt every year through 2036. Most people hear that and think it is just another big Washington number. It isn't. It is a financing regime. It is a rates regime. It is a constraint regime. It is a quiet admission that the federal balance sheet is becoming one of the main engines driving the entire macro environment. And GAO just confirmed it.